Welcome to Fundu Money, your 24/7 buddy on all matters related to personal finance. In this web series, we are discussing various things people need to keep in mind while investing in stocks. Now, the idea of this web series is not at all to make you rich quickly. The idea is to make you into a smart and empowered investor who will be able to use stocks to get the best financial results for your family and yourself.
Which will make you rich eventually.
Yes.
And much more surely than getting rich quickly.
So that's the idea. In a little while, we'll start discussing this. One of these factors, which is basically on dividends. What do you make out of any dividend announcements? And there are a lot of people who keep hunting for regular dividend paying stocks. What do you need to keep in mind? That's coming up shortly. Well, who doesn't mind a dividend announcement, dividend check coming along, and that is something which a lot of investors look forward to. Now, when you are actually when there's a dividend announcement or there's a company which is regularly paying dividends, how does this whole aspect of stock market investing or share market investing, some people would say, how does this come in the whole big picture of an investor? To help us figure that out, the camera will now focus mostly on Mohit Satanan, our stock market expert, who has quite a few things to say about dividend yielding stocks. Mohit?
Dividends don't matter.
Oh.
Okay. In fact, after the government introduced the dividend distribution tax, I would say that a company which declares dividends is actually reducing your earnings potential. It's very simple. Whether the company pays dividend or doesn't pay dividend, the earnings that it makes belong to you in the proportion that you earn shares from the company. Mathematically speaking, when the company earns money, that boosts the value of the share. Now, you can take that value out in one of two ways. The first is to sell the share of the company. Given Indian tax laws, if you hold the share of the company, a public traded company, for over 1 year, when you sell the share, you do not pay any tax, because it is treated as a long-term capital gain, and long-term capital gains in equities are exempt from tax. On the other hand, if the company decides to pay you some of that amount through a dividend distribution, it first has to pay a dividend distribution tax. It's not taxed in your hands, but it's taxed in the company's hands. Company belongs to you, and therefore the effect is the same as if you were getting taxed. And that's why mature shareholding economies like the US, most successful companies don't pay dividend. I think there's only one signaling value to dividend, which is that people feel reassured if a company is paying dividend, because then they say that, oh, the company is actually making money, it's not manipulating its books, it has money to pay out by way of dividend. But if you need that kind of signal from a company, if your level of trust in the company is so low that the dividend makes you feel, okay, this is a decent company I can trust, you shouldn't be owning its shares in the first place.
Well, that must be quite reassuring and clears the fundamentals, investing fundamentals of investors. So you should not be really, what Mohit is trying to say, if I have, correct me if I'm wrong, is that you should not be bothering about share prices or stock prices of companies which are announcing dividends or not announcing dividends. That is really should not be your area of focus. The area of focus again.
If I may, then I'd like to expand this discussion just a little bit and ask you a question. Would you rather hold shares in a company where the earnings are static and where they pay you a 10% dividend, or owning shares in a company where the earnings are growing by 20% per annum and it doesn't pay any dividend at all? For me, the answer is absolutely crystal clear, which is that I would much rather be owning shares in a company which is growing, because eventually those earnings are going to accrue to me, whether in the form of dividends sometime in the future, or more importantly, in terms of the capital appreciation of the share.
Well, there you go again. Earnings is back in the picture. It seems that earnings is the along with the way how well a company utilizes its capital are the two critical pillars of stock market investing. Just in case you disagree with Mohit, what are you waiting for? Go right ahead and write in the comment section. Make it civil, okay? And then, of course, if you're liking the series, we would love to have you subscribe to it. And if you've liked this video, go ahead and click on the like button. And of course, stay connected with us on all leading social media platforms.